Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hey, Jim.
Gold seems to get everybody's attention. Some folks are very worried because the price fell quite rapidly a few weeks ago. Is it a bad bet?
Well, it's a good long-term bet. You know, the world is shaping up as paradise for precious metals. Between negative interest rates and governments spending more than they take in year after year after year, and central banks aggressively increasing the money supply. That's all great for precious metals. But in terms of where the trends are heading in the near term, for instance, the next few months, you know, there's still reason to be a little bit nervous about precious metals because there's this thing called the Commitment of Traders Report, which measures what the players in the futures contracts market are doing with regard to gold. In other words, the paper gold traders. And there are two groups in that market, and one of them is the speculators, who basically trade on trends and emotion, and they tend to be very wrong at the big turning points. Well, they went amazingly long. In other words, they got very excited while gold was recovering in the first half of 2016. And they're now, or as of 2 or 3 weeks ago, they were at record long levels, which basically guarantees, as long as the paper traders are still in control of the pricing in this market, it guarantees a correction in gold and silver. And that's what we've been getting lately. And the last couple of weeks' Commitment of Traders reports show that the speculators are starting to scale back their longs. In other words, they're getting less excited, but they're still pretty long. So we need another few weeks for these guys to work themselves out of their long positions and maybe start going short, because that's how they roll. You know, when the market is going one way, they get on board, whether it's long or short. And so if the gold and silver prices continue to drop for the next couple of weeks, the traders will go very long. And then that's a sign of a bottom. You know, when the traders who are wrong at the turning points place a big short bet on gold and silver, then that's when you know you can probably start getting in and reasonably expect the price to go up over the next 6 or so months. So we're headed for that point. Based on this indicator, we aren't there yet, but another good report, which will come out on Friday and cover the week up until Tuesday. In other words, up until yesterday, as of when this is being recorded. If another good report comes out, in other words, one that shows the speculators having scaled back their longs even further, then we're pretty close, you know. Then it becomes reasonable to start feathering back in and start looking at what miners you want to pick up and start talking about entry points and stuff like that. But in the meantime, there's still a good chance of a further correction. So that's where it is with gold. Now, that's important only if you have money you want to commit in the short run, and you're not just dollar cost averaging the way most people should be. You know, personally, I've raised some cash as things went up earlier in the year, so I've got some cash to commit. So I'm paying attention to this and starting to put in lowball offers on some gold and silver miners with the expectation that maybe they have one more down leg. You know, maybe they drop 10 or 15% from here, then I'll be happy to buy them. So that's where gold and silver stand. And one more caveat. The Commitment of Traders Report, which is basically what's going on in the paper market, will not always work. Eventually, the physical exchanges that are being set up in Asia and physical demand from Westerners who are buying gold and silver coins through online dealers or local coin shops, those guys will start setting prices, and they'll just steamroll the paper markets. And in that case, since physical demand is very strong, we should expect gold and silver to embark on a really nice, fairly steady, long uptrend. And when that happens, then you don't want to care about the commitment of traders report anymore. But until that happens, that's still a pretty good short-term indicator. So that's what I'm looking at now. And assuming this isn't the time when it stops working, we got a pretty good entry point coming up.
Does the outlook of gold really depend on what's going on in the equity markets? Everybody keeps expecting a crash, and then you have somebody like Japan throw in another $32 billion of quantitative easing.
Yeah, when the central banks of the world are buying equities as aggressively as they are, that supports stock prices around the world, and it does it indiscriminately. In other words, the Bank of Japan doesn't sit down and think, well, let's see, is Google a better buy based on fundamentals right now than Amazon? And so should we buy more Google? They don't do anything like that. They just go across the board. They buy $1 million worth of all of these different stocks. And so it pushes things up kind of, at the same time, regardless of fundamentals, which is another way of saying that correlations close up. There's no difference between the trading behavior of all of these blue chip stocks because the main buyers now, the world central banks, aren't paying attention to fundamentals. They aren't trading. They're just buying. And so that changes the nature of capitalism as it's expressed via the stock market in a really bad way. So you don't get accurate pricing signals from the equity markets anymore when central banks are doing this. So in the long run, it screws up the wealth creating process and leads to an even bigger crisis. In the short run, it leads to higher equity prices while central banks are doing this. And since the U.S. central bank is now making noises like it wants to start buying equities too, it means that there are no more fundamental indicators that we can look at and know whether stocks should go up or down. And in that sense, it affects gold and silver prices in the near term because it makes stocks look more attractive than they should look based on fundamentals right now. If you just look at historical relationships between price and earnings, for instance, or price and cash flow, or price and dividend yield, or price and pretty much any other thing that people used to look at, you'd say equities were overvalued almost everywhere. But because you got this new buyer with effectively unlimited funds in the market, that is the world's central banks, who can create as much new currency as they want to with a mouse click, then you can't necessarily say that a PE ratio of 25 is horrendously overvalued and guarantees a crash. You just can't say that anymore because the central banks don't seem to care about stuff like that. They just need to commit money in order to prop up equities, in order to keep people from reining in their spending, in order to keep the economies growing artificially. So this is a terrible thing, and it's going to end very, very badly. But in the meantime, it makes it really hard to make fundamental investment decisions, which means money managers have kind of this nightmarish life now where they're following the central bank, committing capital in ways that all of their training says is a really bad thing to do, but they can't miss the uptrend that central banks are generating, but they're terrified that based on any reasonable valuation, stocks are overpriced and therefore are going to crash. So to the extent that money, because of this, is flowing into equities that might otherwise flow into gold, if people look at fundamentals and decide that the equity market is overvalued, it lowers the near-term appreciation of gold and silver. But the long-term environment for precious metals is just phenomenal because we are actively trying to destroy our currencies. That's the only way out that the central banks of the world see now, is to devalue their currencies really aggressively in order to generate growth, in order to generate tax revenues, in order to keep the governments of the world from going bankrupt. That's the kind of thing that eventually blows up on you, historically. The only difference now between now and the previous crises brought on by this kind of bad policy is that the whole world is doing it at the same time. It used to be one country at a time would kind of flake out and start trying to devalue their currency because they messed up their domestic economy. Well, now you've got the whole world basically in that boat, and they're all trying the same thing. So that is a different element that means this crisis, when it comes, is going to be different, probably much bigger, probably much more chaotic. But it might take longer to get there. You know, nobody has ever borrowed the kinds of money that today's major governments have borrowed. So, nobody has ever been where we are. If you look at each individual country, you know, Japan's government finances are worse than anybody's have ever been, and the U.S. has more debt as a percent of GDP than it's ever had before. And Europe is just an absolute basket case, no matter how you look at it. And China is probably the worst offender of everybody. They've been borrowing more money over the last decade than any country has ever borrowed, and they're still at it. You know, they just added something like $250 billion of new debt to their system in the last month. So this is going to blow up, and when it does, a lot of capital is going to flow into precious metals because that's where we hide out from chaos. And this is going to be chaos with a capital C. You know, it's just going to be worse than anything we've ever seen before, certainly in our lifetimes, Jim, because, you know, we don't remember the Great Depression, and nothing since then has been on a scale that compares to the Great Depression. And this is going to be probably worse when it hits, just because the numbers are so much bigger. We're much more indebted now than we were in 1929. And the world's currencies aren't sound the way they were back then. You know, most countries were on the gold standard or not far from it. You know, even though some of them went off the gold standard in response to the Great Depression, they still didn't take on debt at a rate like we're taking it on now. They didn't aggressively devalue their currencies the way we're trying to devalue ours. So we're making mistakes that are bigger in scale, though not necessarily bigger in kind, than have ever been made in the past. And this inevitably will blow up because the laws of economics and finance can be bent but not broken. So eventually they're going to reassert. And when they do, the governments of the world and the consumers of the world and the corporations of the world will all have to live within their means. And that means they'll all have to scale back. So we're going to have a really dramatic few years where people aren't spending money anymore, and governments are responding to that with bigger and bigger deficits, and central banks are responding to that with even more money creation. And then we're going to end up with something like the Austrian economics crack-up boom, where nobody trusts the currencies of the world anymore, and they start moving all their capital into hard assets like farmland and oil wells and gold and silver. And at that point, precious metals become the thing to own. You know, so it's just a question of when it happens, whether it feels like the right move. You know, and you know, if it takes 5 years, you might get bored sitting in precious metals while you wait for it to play out. But if it takes 6 months to really get going, which it might, then you'll be glad you bought some now. You know, and we can't know which of those two scenarios we're going to see, but the fact that something is coming eventually means that you want to be prepared for it now, at least to an extent. And for the average person, dollar cost averaging is the best way to address that, because you can't know the immediate future. You can have a general sense of the long-term future based on all the debt we're taking on, which is to say chaos out there somewhere, but you can't know when it's going to happen. So get on a schedule of buying a little bit of gold and silver each month and store it safely, or, you know, count mining stocks as your gold and silver, and keep it in a rock-solid brokerage account. And then just let it build up over time. Don't try to be cute and time the market. And also don't really stress out about it if it doesn't work out in the short run, because it's going to work out in the long run. So just let it happen, get on with life, and that's probably the best way to approach this kind of a market.
We'll have more with John Rubino right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with John Rubino. John, oil prices seem to be extraordinarily strong for this time of year. Usually after the end of driving season, oil prices fall, yet we're still above $50 a barrel. Is there anything behind the international scene that might be responsible for that?
Well, oil has been incredibly volatile in the past couple of years, Jim. So the kind of bouncing that we're seeing is just part of the general volatility. And what it's getting attributed to recently is that the oil-producing countries, led by Saudi Arabia, have finally gotten together and at least started to pay lip service to controlling their output. Now, whether they can pull that off, because they don't really get along in other aspects of life. So if they can sit down at a table and everybody accept and then abide by real limits in their production, that would maybe put a floor under oil prices and maybe give it some upward momentum. It's not clear they can do that, but right now the markets are anticipating, or at least giving the benefit of the doubt to that idea. And one thing that points in that direction is the balance sheet of the Saudi Arabian government. They're going broke at a really fast rate. They just borrowed a huge amount of money here. They did a $15 billion bond offering. Now remember, Saudi Arabia is normally a net creditor. In other words, they take in more money from oil than they spend, so they build up a lot of cash year after year after year. Well, that's changed now. Now they're spending more than they're taking in with oil down here, and so they're having to borrow. And the bond offering was oversubscribed, so they ended up borrowing something like $17 billion instead of $15 billion, and that is a huge amount of money for a tiny little country like Saudi Arabia to be borrowing, and it's a sign of how weak their finances are and how scared they must be. So they're probably willing to accept lower production levels for themselves if they can get Iran and Iraq and a few other OPEC members to do the same thing. So we'll see if they can do it. But right now the market is anticipating that they've got a chance, and that's why oil prices are up somewhat. Whether they succeed or not is really guesswork. And I think in the longer run, fossil fuels have really had their day in the sun, and they're going to be rapidly replaced by alternative sources of power like solar power and wind power, and then, really efficient batteries that allow you to run your solar panels in the daytime on a sunny day, charge the batteries, and then run the batteries at night. So you're effectively off-grid. That's worse for the coal market. Coal is really in trouble. But to the extent that this allows the spread of electric cars, that's tough for the oil market. It's also tough for, or another risk to the oil market is the whole self-driving car technology that's coming along, because that's going to make the auto market a lot more efficient, presumably, because people won't need 3 cars in a given family if you can just call up the local version of Uber and have a robot car come pick you up to take you to the store and back. And so it's possible that the internal combustion engine and oil era is now heading for an inflection point where it's been growing year after year after year for basically the last century. Now it's going to start to plateau and then shrink. And so that's a longer-term problem for the oil market. And a probable indicator that even if we see, $100 a barrel again, that will be because of some kind of disruption, a geopolitical thing rather than a market-driven thing. And we're more likely to see a general downtrend in prices over time than a general uptrend. So, I think oil in the short run is going to be volatile because so much of it is bound up with geopolitics, and the Middle East is really on fire right now. And the U.S. and Russia are threatening World War III. That's all bad for for stability in the oil market, because you just never know whether there's going to be a supply disruption or something else which changes the calculus in the market. So you can't really predict anything about oil. But I think in general, as a long-term investment, fossil fuels have seen their heyday, and from now on we're going to see solar and wind get a little cheaper every year and displace a little bit more fossil fuels each year until the solar and wind between them are 30, 40, 50% of the energy market, and fossil fuels, which are now 98% of the energy market, are down to 40 or 50% themselves. And that's a big change. So that more than offsets the whole peak oil thing. So even as we run out of cheap oil, prices can't spike the way they might have otherwise, because we've got these other sources of energy that are already taking market share. And so there's a point out there where oil is going to be expensive to get, and alternative energy sources will keep on getting cheaper, so that it's possible that we won't need any oil at all for a lot of things, just because the oil that we can get to is 3 miles under the ocean floor or in the Arctic Circle or someplace like that, and it's just really expensive to get to. So, or you have to dig up sand and turn that sand into oil somehow by expending huge amounts of energy and water and other stuff we don't have. So it's possible that by the phone call that you and I have in 2075, Jim, when we're doing our 100th anniversary of our radio show, that there just won't be fossil fuels anymore. Now, that doesn't mean really anything for the next few years trading in oil, but it is a long-term interesting trend to keep in mind if you're investing for the long haul. You've got a technology here who does not any longer have the wind at its back. And in that sense, it's not a growth industry the way it has been for the past century.
I think people maybe 20 years from now will look back and say, you actually burned oil to move vehicles. I mean, oil is a very precious resource in the fact that we make plastic out of it, pharmaceuticals, so many other things. And you're right. It will be not used for energy. It'll be used for other things. And they'll say, what a waste.
Yeah. I mean, a century ago for energy, we burned wood and killed whales. And that seems kind of crazy now. And the same thing will be true of fossil fuels at some point in the future. We don't know what point that will be, but maybe our great-grandkids will look back and say what you just said, that, wow, you actually burnt that nasty stuff with the smoke coming out of it and everything, and that seems so inefficient.
But also another phenomena in Vancouver, at least, we're the world leaders in car sharing. Where, really, if your car is parked 98% of the time, which it is, apart from commuting and the occasional shopping trip, why do you need to own a car? And here, where we have dense urban population, people they feel like they're in a club. You just, there's a row of smart cars. You just pick one up, go grocery shopping, park it, somebody else picks it up. They all wave to each other now because they feel like they're in their own little private club. How soon does that phenomena spread?
That is coming faster than anybody expected. And what's driving it is the self-driving car thing. I mean, ride sharing is already a big deal with Uber and the car sharing plan that you're talking about. But what comes next is the automation of that process, where a lot of those cars are just basically robots that come and pick you up. And so, as you said, instead of sitting in a garage for 90% of the time, the average car will just be working 90% of the time. And what that means is we need only about 20% or fewer of the cars that we have now. So that's a much bigger threat to the auto industry than it is to the fossil fuels industry.
Also, what if the cars themselves are made out of plastic? They're going to last a lot longer, too, and I'm seeing that trend.
Mm-hmm. And they get in fewer wrecks if they're driven by robots. So you can have a plastic body that's not necessarily as safe as a steel body, which you have to have when humans are out there making mistakes on the road and everything. So, yeah, and it's going to be a very different future, and it's coming amazingly fast. You know, the idea that there are robotic cars on the road right now is amazing to people our age, at least. You know, to kids, it's just the most normal thing in the world, like every other aspect of technology. But the idea that trucks are moving products around Pittsburgh or wherever and doing it without human drivers is really amazing. And the way artificial intelligence works is that it learns by doing, and it learns very quickly by doing, so that, let's say 5 years from now, it's not going to be unusual to see self-driving cars on the road. And then another 5 or 10 years after that, it's going to be unusual to see humans out there. And that's great in some ways because it relieves you of the stress of, for instance, rush hour traffic, right? You can sit in the back of your robot car and work for 2 hours if that's how long it takes you to get there, instead of having to fight traffic and be all stressed out when you get to work. And, so you become much, much more productive. And to the extent that those cars are electric, that's where the really big deal for fossil fuels comes in. Because, for instance, Tesla is testing self-driving cars now. And those are electric cars. So as the battery technology that runs electric cars gets better and better, which it is, we hadn't put much research into battery tech prior to laptop computers. And now we're putting a ton of research into it because it's clear that that's the linchpin technology of the alt energy takeover of the world. If you've got good batteries, you can do everything else. And it's working. A lot of batteries or a lot of different battery techs are coming along that are better than their predecessors for given niches. Some of them are lithium ion, and that's what runs cars right now. Others are other kinds of technology for storing the energy that comes from a solar or a wind farm, or for running a house after the solar panels have stopped working, things like that. But each variant of battery tech is getting a little better year after year. And then there are lots of breakthroughs that are coming out of labs that sound revolutionary and haven't revolutionized the system yet, but all it takes is one, And when that comes, then it's just about lights out for internal combustion engines. If you can get enough, for instance, lithium to run a world of lithium-ion battery-powered cars, and they turn out to be a little cheaper and a little more efficient in other ways than internal combustion engines, and especially when you factor in the environmental issues, which are huge for internal combustion engines and relatively minor for electric cars, then the change happens very fast. And we've seen that happen with other technologies here where 20 years ago people were still using film in their cameras. Now nobody is. 15 years ago people used dumb phones, little flip phones that just made phone calls, and that's all. And now everybody has a smartphone. And self-driving cars is kind of a similar idea. It's software, not hardware. And electric cars are halfway between software and hardware because, solar panels are, to an extent, just microprocessors, and they get cheaper year after year after year. So the energy that animates an electric car is going down in cost.
Well, Britain, too, is going to try to deal with range anxiety when it comes to electric vehicles by creating lanes that charge your car as you drive. They're committing almost $1 billion to test this out.
Yeah. You know, the amount of creativity that's going into the alt energy market now is really impressive. They're coming up with a lot of cool stuff, and most of it won't work. Some of it will, and the part that does work will be revolutionary. So yeah, there are cars already out there, electric cars, that have ranges of 200 miles, and that's pretty close to as much as you need, as long as there are chargers out there in the world. You know, very few people drive more than 200 miles in a given day.
And a Tesla as well on the computer tells you when you're getting low and where the nearest charging station is, so it never lets you run out of power.
Oh no, you don't space out in one of those cars and just forget. You know, it takes care of that for you. And to the extent that there are more and more chargers out there, then range anxiety becomes less and less of an issue. So it starts in densely populated places where it's economic to put a lot of chargers around, and then that spreads. And they're also coming up with fast charging technologies where you don't have to charge a car overnight. It'll charge in 15, 20 minutes or less, and so your stopover, you know, your waiting to recharge is not this onerous thing that it was with the original generation of electric cars. So
and that might bring back the old phenomena of very nice restaurants at your car and truck stops.
Oh yeah.
You know?
Yeah, there's a definite market niche for charging stations that are a lot more than that, you know.
John and Jim's recharging restaurant.
There you go.
We'll have a chain. John, Thank you so much for chatting with us.
Sure thing, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio, on Twitter at TalkDigitalNet, YouTube, Talk Digital Network. Questions to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.